disappeared, and now I just hit the record button because I had intended to be recording and I hadn't started that yet. So now let's see if I get back. Are we back to seeing sort of our Canvas homepage? Is anybody out there?
Yes, we are.
Okay. So now we're recording for those of, for the people that couldn't be here with us. So, let's talk about a few other things here. So there is a practice quiz here that I put up today, and it has the correct answers on it. So you see down here the little star by D, and so that is the correct answer. And there are, I think there's 9 or 10 questions here. And so these are kind of, maybe are in line with what you might see on a midterm. And so I would encourage you to review these and just see if you can make the, the questions and the answers begin to make sense. And then I just want to point out also that in next week, I put a sample midterm. And so there is this here. I would ask you that sometime in the second half of this week, please try to give this sample midterm a try, because by the end of this week, you'll kind of be in a position to do decent on most of it. And I will probably use it to talk about, to sort of guide and have us do part of our discussion next week. So maybe give that a try. We don't really have week-to-week homework until we get to some of these tax problems. So that can, these last two things that I've shown you are an attempt to try to give you a sense of what to expect in terms of level of difficulty on the midterm and those items as we move forward. And then the other thing to try to do for next week is here is our first tax problem. So here's the problem, a couple of people, 45 and 42, social security numbers, dates of birth, wage income for both of them. They've got some bank interest or mortgage interest, some tax-exempt interest, some jury duty pay, some workers' comp, and then they have a dependent who's 7, a date of birth information there, and then their 2 jobs, and we have to prepare their tax return. And so that is not due until week 3, which will be Saturday of week 3, but I would like you to get out the 2017 1040 form and begin this problem, so that once again, this can be something that we can spend a little time discussing next week, so we can kind of discuss those sample midterm problems, and we can discuss your work on the first tax problem, and then, to sort of help guide you towards where we want you to be in terms of understanding and those types of things. So you have been doing just a tremendous amount of reading. I guess before I start talking about some of the main topics I want to talk about tonight, I'll just point out here that I put up this 1040 overview form, or overview YouTube, which is kind of I basically walk through the form 1040 and I tie it to that individual tax formula that we discussed earlier. And so I think it's about, I don't know, maybe about 20 minutes. And so like the things we saw last week, I think you'll find that helpful. And then the other thing, one of the big things for this week is the definition of income, what's included and what's excluded, and beginning to get a handle on those types of things. And so that audio file there, which I don't recall exactly how long it is, I think you'll find that to be helpful also. So let's talk a little bit about the reading and what's in the text. One of the things that I would prefer that you not try to do is don't get excited about the phase outs. I was thumbing through the chapter earlier today and got to the part on credits. and they were talking about the educational credits and when things phase out, and the itemized deductions phase out, dependency exemptions phase out, lots of credits phase out. And basically what happens is when you get to some income threshold, then as you go beyond the income threshold, there's some linear relationship that the more you go above the income threshold, the credit or the deduction or the tax benefit is eroded kind of, for every $2 that you go above the income level, the deduction may go down by $1 or something, but there's some pro rata reduction. Those are always done by the software, and we can always look those up and figure out how to do those after the fact. And so I am more concerned that you focus on the broader level concepts. Even though our book has a lot of detail, I'm not going to hold you accountable to that detail because again, I think that that's something that isn't going to stick with you long term. And so focus on the general ideas like, oh, we have educational credits or we have educational incentives. One of them is a deduction above the line that doesn't get used very often, but then we have two credits. One is the American Opportunity Credit, which is a maximum of $2,500. And then we have a Lifetime Learning Credit, which is up to $2,000. The American Opportunity Credit is a more juicy credit because it's 100% of your first $2,000 of qualified higher educational expenses for your first 4 years of school. And so it's really just those broad brush strokes that I'm hoping that you will retain, along with a sense of how things are structured and why they're structured the way they are. Now, in addition to that, I want to add that it's an interesting time for us to be talking about tax because we've just undergone the largest overhaul or change in the tax code since 1986. Part of the Republican Congress and President Trump's agenda was an attempt to try to simplify the tax code. I think you'll see as we move along here a little bit that they weren't really successful at simplifying the tax code, but there was a significant cut in taxes. There was a bit of streamlining, and there are some significant changes going on. We will talk mostly about the 2017 tax code because that's the tax year we just finished off, and because that's what our book covers, and also because the new tax law, although it exists, there's not a lot of resources and information available about it yet. The actual law itself was about 1,000 pages. There is a pretty nice 30-page summary out there. Maybe I'll give that to you at some point that will kind of outline the differences. But I will talk about those differences as we bump into them as we go through our materials. So we'll start to see some of that tonight when we get to talking about income. There'll be a couple of things that will change to be different than what's in your book. I will point those out to you so that you know those. But we will always go back for the midterm or for the tax problems to what is in the text because it's kind of difficult to hold you accountable for things that are not even, accessible to you yet. So I hope that all makes some sense. So let's go here. And so I want to use this, this PDF, I guess, for lack of anything better to call it, sheet to sort of guide a little bit of discussion or talk a bit about gross income. That is, I think, an item that begins in Chapter 2 and it kind of spills over into Chapter 3. But when the tax code talks about income, one of the things that it does is and you notice that our individual tax formula says income broadly conceived. The tax code basically says, well, this is kind of a weird way to say it, but in the past, people have said the tax code does not specifically define income, it defines what isn't income. Basically, it's a negative definition. Everything is income unless there is something that specifically excludes it. And so, I guess if you had to guess whether or not something was income or not, you should guess that it is income, because you can see this list is a fairly kind of extensive list. We'll talk about it more in just a minute. And then the items that are not income, or the items that are excluded from income, is also a list. But as it loads here, you can see that it's not as big a list. And so there's about 2 things that are included in income for every 1 thing that's excluded. So 2 to 1 in the advantage of including it. And so I guess if you have to guess on a multiple choice question, guess that something is included in income. But remember this idea that when in doubt, it is income unless we can find something that excludes it. And these terms are the way that we generally refer to income. It's included in income, or it's excluded from income. So let's work down the left column first and then the right column, and we'll talk about these things. So alimony is the first interesting thing. In a 2017 tax return, well, this is not true. How's that for a great lecture? Start something, then say it's not true, and then not say anything at all. So for divorces before the end of 2017, if you received alimony, that is going to be included in income. And then if you paid alimony, that is going to be a deduction from income, or a deduction above the line. And so if you paid $1,000 a month in alimony, or you received $1,000 a month in alimony and you were divorced before the end of 2017, then that $1,000 gets included in your income. The payor is probably going to get a deduction for it. This is one thing that has been changed in the new tax law. The alimony is no longer included in income, and it is no longer a deduction. But it doesn't depend upon the tax year in which you file, so it's not like it's all done now. It depends upon when the divorce occurred. And so for a period of time, we're going to have to look back and ask people that were doing their taxes. So I see that you're indicating here that you paid some alimony, or you received some alimony. Can you tell me when your divorce was finalized? And then depending upon when that date was, will determine how that alimony is treated. This is an interesting change that they've put into the tax law. I think that there's a little bit of social engineering going on here. The Congress felt that a divorced couple could transfer income from a high wage earner to a low wage earner and get a tax deduction, but a married couple couldn't do that because they were married, and they were married filing joint probably. And so I think this was an attempt to try to make the treatment of tax returns between divorced couples and married couples on par with each other. So that's kind of the little series of rules, and the first thing around one of our income items. This next one, amounts recovered for after being deducted in prior years. This is a little bit of a weird rule, but say that I deduct a loss on my Schedule A for a casualty loss. My house burns down and I take a $20,000 deduction on my Schedule A, but then in a subsequent year, an insurance company pays me for it and I make a complete recovery. Because I had a deduction in a prior year and then I had a complete recovery in the next year, the recovery is probably going to be income in the next year. And this comes up from time to time with various insurance issues related around health insurance, casualty losses, just cases where I have recoveries. Annuities are included in income. Awards are included in income. So some of these I'll spend more time with. Other ones are, just sort of straightforward. Any kind of award you get, except for a longevity award that's somewhat minor in nature, is going to be income. So if you win a literary award, you write a poem or something and send it to the, whatever the Blue Mountain paper is, and they publish it, and you get a $25 gift card to the bookstore. Technically, that $25 is income to the recipient. The recovery of back pay is income. Bargain purchase is kind of a weird thing. Um, if you if you if you work for somebody and you buy something above cost but get a discount, that's not any kind of deal. So let's say you work for I don't know, some clothing or apparel store in Pendleton, and you can buy stuff 25% off, but that 25% off is still 10% above cost. That's nothing. We're not concerned about this. A bargain purchase is when I give you just such a sweetheart deal that it's below my cost. So imagine that I'm running a car dealership and I have a really great employee, and I don't want to pay them income because I know it will create a tax for them. And so I give them a car for $1. I literally sell them a brand new car for $1 and say, well, that's not income to the person because they paid for it, they bought it. Well, that's a bargain purchase because it's below cost. And so when you start to sell items below cost, particularly to employees, then that creates income situations for the employees. And by the way, you guys seem really quiet. If you have any questions at any point along the line, just scream or say something. Screaming's optional. Bonuses, income. If you win a lawsuit, this is kind of weird. If you win a lawsuit, you can have a great big huge tax bill. And if you win a lawsuit for back wages, for breach of contract, for discrimination of some sort, almost all of that is income. The only income from a lawsuit that is excluded from income is if it is for physical damage. So if you have health-related injuries, or you have your car repaired, or you're just being made whole again, then that is excluded. But emotional damagement, punitive settlements, and then any kind of other legal settlements are income to the recipient. Business income is taxable income. This one's tough. All of you that had a lemonade stand when you were a kid, I hope you filed a Schedule C and a tax return, because when you sold that lemonade, you were engaged in a business activity, and that Schedule C income was indeed reportable. You should be aware that some of these things, what the law says and what happens in reality is sometimes different, but it's kind of important for us to get at what the rules say we should be doing. Clergy fees and contributions, generally income. This is kind of hard for people to understand, but if you go to, most, I'll call them church officials because I don't know exactly what the best term is to use, but most clergy officials, church officials, they're usually paid by the congregation a certain amount. And that's probably wage income that they're getting a W-2 for or something like that. But when they officiate, say, a wedding or a funeral, and that wedding or funeral may be outside of the church, or it may be in the church, but it could just as easily be at a park or at a cemetery or wherever this event is happening, then sometimes clergy will be paid. And sometimes it's not always a fixed rate. It's, maybe based on what the parties that have deployed the clergy can afford to pay, but that is like self-employment income and needs to be reported. Commissions is income, any compensation for services is income. Contributions we've got there. Damages for non-physical personal injury, I kind of already alluded to that. Death benefits, kind of weird. If you inherit something, then that is an excluded item. So what they mean by death benefits here is something more like, it's not insurance, it's not an inheritance, but we just decide to pay you a couple months extra pay after you're deceased because we feel bad for your family, and so we keep you on the payroll to use out your sick leave or something because we want to be helpful. Death benefits that are not inherited or not insurance oriented and are kind of exceptions are income. Debts forgiven. This is a tough one. If you file bankruptcy, well, maybe not if you file bankruptcy, but if somebody forgives a $10,000 debt, that $10,000 is going to come to you if it's properly reported on a 1099-C for the cancellation of debt, and that's going to be income to the person who had the debt forgiven. Now, there's a lot of exceptions to this particular rule. The two main exceptions would be possibly if you had cancellation of debt on your principal residence because you were upside down in it. That was something that we sort of did during the Great Recession because a lot of people were in that situation, and it felt like they didn't create that problem on their own. It was sort of larger than them, created by the economy, and so there was a tax law change that made an exclusion for that. And there's also an exclusion if you're insolvent or in bankruptcy. But if you generally just are forgiven a debt in some kind of, you agree to a lesser amount or something of that nature, then that is income. And I should say here that the complexity of a lot of these issues is not so much because Congress wants to make everything complicated. It's because at some point somebody has tried to work their way around the law. So let's say that once again we'll go back and I'm running that car dealership and I have this great employee and I just really, I don't know why I think car dealers are unethical, but apparently I'm picking on them tonight. And so I want to put money in this person's pocket, and I don't want it to be wages because I don't want them to have to pay taxes on it. So I say, wink, wink, I'll loan you $10,000. And so I give them $10,000. And then next month I go, oh, it's okay. You don't have to pay me back. Now, that's what, forgiven debts is income is supposed to try to prevent or get around. It's not so much when a person is legitimately, insolvent or has a bankruptcy problem or is losing their home. We've had to create some rules and draw some lines so that there aren't these sort of abuses or passing of income from one person to another. By the way, the person who loses on the debt is going to write it off as bad debt expense. So if we do this just right, I could create a $10,000 business deduction for a business, and then I could put $10,000 in the pocket of somebody without any taxes, and that would be that would sort of be like working our way around the tax code. And so we have these, we have to write complex rules to try to hem people in so that these types of things don't happen. Director's fees. So if you get elected to, some corporation's board of directors and they pay you some kind of a stipend or a fee, that's income. Dividends that you earn on stock, income. This is always a tough one. If you embezzle money, it's income. This is sort of the Al Capone rule. Well, it's not so much the Al Capone rule, but whenever there's a situation where somebody steals money, sometimes they get prosecuted, sometimes they don't, but sometimes they get caught by the tax code because they're supposed to report it as income. So next time you find somebody stealing money, make sure you remind them to report that on their tax return. Employee awards, we sort of already touched on. Employee benefits is kind of a tough area. Lots of things are excluded, things like health insurance, but other things are included. What this really boils down to is whether or not this benefit is for you, the employee, in which case it's probably income, or if I'm providing it in some way for the business. And so I'm going to leave this one aside, and we'll deal with it more at a later point. Bonuses, stock options, if you have income from an estate or trust, those are all income. If you make money farming, and that could be growing corn, growing wheat. I think a lot of the new marijuana farms are that's farm income, and they would be reported on a Schedule F, which is where farm activities are reported, and it also includes ranching activities. So if you were doing pork or chicken or cattle, or even if you were doing orchards. Let's see, you guys are in Pendleton, so across the way there, Hood River, the Dalles area, they grow a lot of, apples and pears and stuff in that area. So those are all farming activities. The moment that you move into the retail side of that, so we'll go back to marijuana. So if you're growing marijuana, you're a farmer. That's a Schedule F activity. If you're a retailer, then you're self-employed unless you're, a corporation or something like that. And then that's a Schedule C activity. So lots of rules around farming, very interesting area of the tax code. I know preparers who almost specialize in just doing farms. And this is true. I know preparers that specialize in just doing, or they have a large percentage of their practice in clergy people. Most of us cannot be an expert in everything in the tax code because it is so immense. I think I mentioned last week that you can do a 2-year master's degree in tax, that it's really not the kind of situation where one person knows everything. Most of us know enough to do the average tax return, and then we tend to specialize in areas that are, of interest to us, or where we've, got a sort of a larger congregation of clients, I guess. Fees that you earn, income. If you get a free tour, might be income. So instead of picking on the car dealership, let's go to Royal Caribbean or the Carnival Cruise Company. I'm not sure what the last part of their name is, but you work for one of these companies, you're in sales, and they, if they give you a trip at cost or slightly above cost, then you've got nothing. That's no income, nothing to worry about there. But the moment they give it to you below cost, you've got a free tour, and so there's probably going to be some amount that needs to be included in your income for the tax year. And a lot of companies do that because they want you to be aware of the types of services and things that they provide. They think it makes you a better employee, better salesperson, possibly. So free tours, income. Gains from illegal activities. I don't know why it says from, but it should say from. But so the next time you make some money doing something illegal, be sure to report it. I don't know exactly what that would be, but who knows? All kinds of things could come up there. If you make money selling property, that would generally, if you make money or gain selling property, that's normally a capital gains type of activity. We have an exclusion. It's called the Section 121 exclusion for the section of the tax code that excludes gains from the sale of your primary residence. If you've lived there 2 out of the last 5 years, then a single person can exclude a gain of $250,000, and a married filing joint person can exclude up to $500,000 in gain on the sale of your personal residence. So that's an included item until we can meet the rules for the exclusion. If you win at gambling, it's income. So next time you play poker with your friends and you walk away with a 20 spot, make sure you report that on your tax return. It would probably go on line 21, other income. Once you have gambling winnings low, you can report your gambling losses, but that's a separate issue. If you're given insurance in excess of $50,000, the excess premium is income. So if I am an employer and I provide you with $100,000 of life insurance, and let's say that $50,000 costs me $2 a month to give to you, and $100,000 costs me $3.75 a month to give you, that $1.75 additional amount that was the premium for the excess insurance needs to be put into your W-2 somehow, and needs to be reported as income to you. Hobby income is income. So if you run across somebody who's trying to make some money on the side, trying to think of all the ways that people are making money on the side now. Way back in the day, it used to be things like, I think there was something called Amco, and then there was Mary Kay, and then there was Avon, and then there was Party Light, and then there's a bunch of them, a lot of these network marketing things. Of course, those are not the only hobby income. I mean, you could be trying to make some money I don't know, maybe you're buying and selling baseball cards because you love to collect those. And if you're making money at something like that, you have an income situation. There's some complicated rules with the hobby income that we'll want to talk about in greater detail when we get to self-employed people, because if you miss these rules here and get classified as a hobby, it's really bad. Incentive awards, you know, if you perform this way, or if you make this many sales, or you meet quota, you get this bonus. Those are all taxable. Interest income, if you get paid by the courts for jury duty, that's income. Most of these, for jury duty, what tends to happen now is you tend to give that money to your employer, and your employer often will just pay your regular pay. But if that's not always the case, maybe you're not employed at that time and you get paid a small amount from the court, it's income, other income. This whole living quarters and meals, this is tough. Here's the easiest way to try to think about this. If I give you a place to live as part of your employment, let's say I'm, I don't know, you know, in my neck of the woods, I'm in Eugene, Oregon, so I would normally go for the University of Oregon, but I'll use OSU today. So Oregon State University. If we hire a president for Oregon State University and we just want that president to be available to us 24/7 for all kinds of things that are going on, and so we give them a mansion on campus to live in, that is probably, if they don't need to live there, that's probably income to the president, the fair market value of that residence that they live in, probably income. And then I'll give you the opposite extreme. Let's say that we're running an oil rig in the Gulf of Mexico, and I fly you out on a helicopter and you like work on the oil rig for 4 days, and you like sleep in this barracks thing with bunks and a bunch of, you know, smelly other people. In that case, I'm completely giving you that place to live for the benefit of the employer so that you can do the work, so that you can function. And so you're not really getting anything great. And so that's not income to you. So the fire, you know, the medical professionals and the fire professionals, when I make them live at the fire station, or I make the doctors sleep in the, you know, in the, you know, in the break room or something like that, or in the supplies closet or something like that. Not like in television with the other people they work with, but all by themselves because they're tired. In that situation, because it's so they can be there, so they can do their work, it's not income to them. But when I'm providing you like a nice place to live and it's not really essential, then it is income to the person who receives that benefit. You know, if I just give you money for mileage and I don't make you do any kind of an expense report, that's income. Certain you know, most military pay is income unless it happens to be combat pay. Notary fees, partnership income, pensions, prizes, professional fees, punitive damages, all income. If I reimburse you for moving expenses, let's leave that one alone. We'll talk about that one in a little bit greater detail. If you receive rents, so if you, you know, if you buy a duplex and you rent out both sides, or you rent a room in a house that you have, you technically have income, and then you have certain deductions that you can do associated with that. Rental income for property goes on a Schedule E, and we'll spend a week kind of looking at rental activities in greater detail later on during the term. Retirement pay from your pensions, generally income. Rewards, so if you find somebody's dog and they give you a 20 spot, that's income. If you turn in a criminal and you get $1,000 reward, that's income. Royalties from, you know, if you have license agreements because you created a sweet piece of software, or you wrote a book and you're getting royalties or something like that, you may have income from that. Salaries, scholarships for room and board are income. Scholarships for education are not. So the difference being what the scholarship is for and how much it is. So most scholarships, for that reason, tend to run out right around the total cost of tuition plus books. But if you do get scholarships in excess of that, you may have some income. Chances are, if you don't have a lot of other income, it may not end up being taxable, but it may have to be reported, and then you may have to figure it out. severance pay, strike and lockout, supplemental, tips. Tips is a tough one. Tips over $20 have to be reported by the employer, and there's a bunch of detailed stuff that goes on. But all tips are income. So if somebody gives you a 5 spot for a tip, you're technically supposed to report that on your tax return. Your employer doesn't have to do anything about it, but it is income. You can bet that a lot of those aren't reported, but the IRS does have some ways where they try to get at what they think the tip income should be and whether or not it's properly being reported. I'll give you one example of that. For let's say somebody who generally might get a lot of tips, like let's say a bartender, or let's say a hair professional. One of the things that they will do is the IRS will look at all of the credit card receipts, which now have to be reported on I think it's a 1098K, maybe it's a 1099K, but it's sort of all of the credit transactions of the business, and so they try to figure out what they think, say, 10% of that would be and what a reasonable tip amount is. And then they might look at a hairdresser or look at a bartender and look at their income and try to figure out whether or not they think they're grossly underreporting their tip income. So these things occasionally do get tracked down or followed up on. People do get into trouble from time to time. Travel allowances, if there's no reconciliation on them, then, like I just give you money to travel, then that's income. Unemployment compensation, that one seems weird. We'll talk about that one in more detail. And then, of course, wages. Wow, that's a lot of stuff. Are you guys still awake? Wow, apparently not. Oh, there's a few people, huh? Now, much of this is probably repeated in that audio file that is up there, and so and much of it is also in the reading. But I thought this would be a kind of a good thing for us to jump through a little bit. Excluded items here. I think the important ones, child support payments and bequests. So if somebody just gives you something, like it's just a gift, you just inherit it, somebody bequests something to you, there is no tax to you, the recipient, for having received that. There is possibly some taxes at an estate level that is kind of a separate part of the tax code. There's estate and trust income and estate and trust issues. That could be an issue, but just if you inherit $10,000 from a long lost uncle, or somebody just gives you something, then it's a gift and it's probably not income. Child support payments, not income. So there's a little bit of a battle here. Before the tax law was recently changed, the recipient of divorce settlements wanted it to be child support because then it wasn't income. And the payor of whatever the divorce settlement required wanted it to be alimony so that it would be deductible. And whether or not something is alimony or child support depends exclusively on whether or not it is tied to the kids in any way at all. So if you have a really bad attorney, I want to make some attorney jokes here, but I'm going to bite my tongue. And they say, well, you're gonna pay alimony of $500 a month until the kids reach age 18. You just now turn that alimony into child support because you tied it to the kids turning 18. And it doesn't matter that you call it alimony. It doesn't matter whatever you say in your contractual agreement with the party that you're breaking your contract with. It doesn't matter at all. The tax law trumps whatever your court decree says. And so if it's written wrong, then it can be child support or it can be alimony on accident. So it's important that you have, that people that need representation in these issues get people that know the difference between the two. Any damages to make you whole is excluded. Anything for your personal injuries or sickness is excluded. Disability benefits uh, this one's tough. If I buy disability insurance and then I later get paid disability benefits, if I bought the disability insurance with after-tax money, the benefits are tax-free. If my employer buys a disability benefit package for me and I never pay for it and it's never taxable in my income and then I later receive benefits, then the benefits are taxable. So there's this relationship between the insurance and whether or not I have any skin in the game, so to speak, whether or not I purchased it with after-tax money, then the benefits are excluded.
So where would comp fall in that?
So workers' comp is excluded. So kind of weird. Unemployment, because so unemployment income is included in income because I've purchased an insurance with pre-tax dollars usually, but workers' comp is excluded by definition. And so if I'm on a safe claim or something like that, and I get a payout of some sort, there's no tax on the workers' comp claim, but there would be income tax on unemployment compensation. So, some of these things don't always make, they're not relational, I guess. If I were just to sort of rationally sort of think about it, I would think like, well, unemployment compensation and workers' comp, those are people that are kind of in a tough circumstance. The workers' comp and the unemployment benefits never are going to equal their total pay, and so let's exclude both of them. But that's not how it works. We exclude workers' comp and we include unemployment benefits. So that's kind of a little anomaly, I guess, in how these things work. Health insurance proceeds, not included in income. Again, inheritances. Here's a tough one. Life insurance proceeds is not included in income, but if you have interest on the proceeds, that is. So let's say you somebody has a $50,000 life insurance policy and you're the beneficiary, and so you receive it. If you take the $50,000 in cash immediately, it's not income. But the insurance company is going to offer you a deal. They're going to say, well, how about we pay you $5,000, or how about we pay you $5,500 each year for 10 years. Do you see how that works? That they're paying you more than the $50,000, but they're paying you over time. The excess, in this case, the $500 out of each $5,000 payment is excess, and that's included in income. So anytime there is an amount that is extra because of some time settlement, then that portion only becomes income. And you will see that discussed in the reading when they talk about annuities, and you have to do this little calculation to figure out what is the return or the tax-free part and what represents the additional interest that should be included in income. Here's back to the meals and lodging thing. Certain military allowances for combat pay excluded. If we give a minister a residence, that's excluded. So if they live on site at a church or a worship facility so they can be available to people who are in distress, then that's thought to be for the benefit of the congregation. And so that is not included in income. It's excluded. Municipal bond interest. So this brings us to what's referred to oftentimes as the reciprocity agreement. So federal interest payments or federal debt payments, the interest on the federal debt, is not taxable at the state level. And state debt payments is not taxable at the federal level. So let's say you buy some U.S. savings bonds. The interest income on those is taxable at the federal level, but is not taxable by Oregon. Let's say you guys are at Blue Mountain Community College, and so let's say that the college floats a bond to build some new buildings, and those bonds, of course, are debts, and you buy some of those municipal bonds to help fund the school, and you earn 5% interest on those. That is not taxable at the federal level. One of the additional nice things about municipal bond debt is if it is from the state in which you reside, it's also not taxable in that state. So if you were to buy Oregon municipal bonds, they would be excluded from federal tax and they would be excluded from Oregon tax. If I happen to buy, I don't know, Arizona municipal bonds while I live in Oregon, they're still exempt from federal tax, but they're not exempt from Oregon tax. So sometimes if you're in a high marginal tax bracket, one of the things that you do is you buy municipal debt from your state so that it is duly excluded, and now you have some income that is not subject to taxation, which can help lower your effective tax rate. So that's kind of a fun kind of thing. If I pay you to relocate, as long as I don't exceed your actual expenses, then that's excluded. Whoa, phone's going off. Scholarship for tuition and books is excluded. Social Security benefits. So Social Security benefits are generally excluded unless you make too much money, and then they're included in your income. I won't hold you to how that calculation is done because it's done two ways. If you're over 62 but before your full retirement age, there's quite a stiff penalty on your Social Security for having income. And then there's a different set of rules that if you're of full retirement age and your income is too high, then we start making some of your Social Security subject to taxation also. So for people of very moderate incomes, their Social Security benefits are excluded. Veterans benefits excluded, welfare payments excluded, and then workers' comp excluded also. So that's a lot of stuff. I mean, that is kind of a really rapid overview. I will point out that, again, that is probably repeated here in an audio format. And then there is the overview of the 1040, which I think is really worth your time here. And that's a YouTube video because that's going to help solidify the formula and how the Form 1040 relates to the formula. The one thing that I really hope to add for this week will be a YouTube video on some of the credits. And in particular, I want to talk about the child tax credit, the educational credits, and the earned income credits. I'm not going to talk about every credit, probably the child and dependent care credit also, because there are more credits than we have time to discuss. But watch for a 20-minute YouTube coming on credits, because that is something that we didn't have time to really talk about tonight. So for this week, I think what you're doing is you're reviewing all of this stuff in week 2. You're doing this practice quiz that you have answers for. You're working on the practice midterm for next week. And then you're probably starting this tax problem. And so we will talk about all of those things next week, and then also get into some of the adjustments to income like IRA contributions and whatnot. So that's all I wanted to talk to tonight. Let me stop sharing. Let me open up my video. Are you guys out there still? Oh, look at that. Some of you are. Can I do anything for any of you guys? Any questions about things at this point?
So I had a question about the forgiveness of debt.
Yes.
So I work for a company and you forgive debt. Do we need to give them sort of saying that we're forgiving that?
You're supposed to.
Gotcha.
You know, to be honest, most of the big players, like if you work at a large credit union or, you know, Bank of America or, you know, one of the mortgage companies, the people that buy mortgages, they're pretty up on this, and they do 1099s on a pretty regular basis, the 1099-Cs. But you will find a lot of smaller entities, or maybe if somebody does a private loan, then the 1099-Cs are probably not getting done. There is a penalty for not doing the appropriate 1099-Cs. It can be up to $500 a form, and so you like to do those if you're supposed to. But there is a percentage of them that's probably not getting done. They may be getting done at your business. You just may not be aware that they're happening. Somebody else may be, doing all of that paperwork reporting.
Yeah.
Here that needs to be.
Okay.
Other questions from anybody? Do you have a sense of what you need to do this week and how to be successful going forward?
Yeah.
Okay. Well, thanks everybody for stopping in. I'm going to try to stop the recording.